Hi, this is Randy Finney with Right Side of the Chart, and this is a midday market update for Monday, December 31st, 2018. As we head into the final few hours of trading for the year, I just want to do a quick update on the charts, where I think things are going. And, as always, I'll share my thoughts. I'm still looking for and expecting a considerable, more upside. We've already had a pretty decent rally so far. The markets are roughly, I'm just rough estimating, about 7% off the lows, a little bit give or take on the S&P 500, and I'm still looking for some more upside here in the near term. Now, volatility is, I don't want to say here to stay, but we're still, at levels of elevated volatility. Volatility doesn't just mean going down; it can mean strong up days as well. Um, I want to put things in perspective too. Most of you probably know this, but we had that big sharp rally on the day after Christmas on the 26th. I know the headlines, when you read the headlines, talked about the Dow's biggest point gain ever. Keep in mind that's silly math. I don't even know why they mention those things. The rally that we had the day after Christmas doesn't even rank up there in the top, largest one-day rallies in percentage terms. As time goes on, the Dow, let's just look at the Dow, the points go higher and higher and higher, the scale on the Dow. Let's go to a monthly chart. Here's a long-term chart of the Dow going back to the 70s. Back here, the Dow was, six, seven, 800 points, and recently peaked out around over 26,000. So look at it this way. When you have a $10 stock and it goes up 1 point, that's a 10% move. When that same stock grows up to, gets up to $100 a share and it moves 1 point, that's merely a 1% gain. So on the Dow or any index, that's why I use log scaling. It paints a true picture. If you don't use log scaling, this is what the Dow would look like with arithmetic scaling. It looks like a parabola, and it's not, or a parabolic advance. Again, because what log scaling does is it puts out all the candlesticks and everything in your chart in equal percentage move. So, this candle right here, if it's the same size as this candle back here when the Dow was roughly 10,000 points, it's the same percentage gain or loss. And so again, it was, now by all means, it was a sharp rally, but it's a typical bear market rally. I've traded through, lived through several bear markets, traded through the last one as a full-time trader, and can tell you it's just what happens. And when the rubber band gets so stretched as it was leading into, Christmas, and since then we've snapped back. And again, a lot of it was priced into the charts. I don't want to rehash my recent analysis. I showed you, key stocks like Amazon hitting my final target and everything else. So um, while there are no guarantees, and that's what stops are for, I'm going to share my thoughts with you, share targets, where I think things are going. If you're of a different mindset, if you want to short this rally or any rally in the near term, to add back swing shorts, by all means, I can highlight where I see resistance levels, where we're likely to have a reaction, what levels might provide an objective short entry, whether it plays out or not. Never confuse objective with high probability of success. An objective, trade, if you're going long at support with a stop not below and you have an attractive, risk reward profile that, and the charts confirm that would be an objective long entry, whether or not it pans out. So where we're at right now, let me share my thoughts. I think a lot of the easy money's been made, and again, unfortunately, I had to be, I was away on vacation with my family, and a rare vacation where I wasn't in front of the computer. Most vacations I take are usually mini vacations. If I go anywhere for a week or more, it's usually a working vacation. I'll bring my laptop, but I didn't have that luxury last week. But neither here nor there. I talked about the risk reward being to the long side, and this is what happens when you stay too long to the party when being short. Like I said, short covering bear market rallies are explosive, and you will give back some or all your gains in the blink of an eye. And so now let's just look at where we might be headed from here. Okay, I shared my thoughts last week. Nothing much has changed. Let's just focus really on the near-term charts right now, 60-minute charts. So in last week's update, and this is the QQQ 60-minute chart. We took out this downtrend line here, And so far today, we've back tested. So we had a little pop this morning, came in back test. We've been back testing the trend line and expect us to move higher. Hard to say exactly, it's always hard to get all the squiggles right, but, we could come in and test this uptrend line. Or we may have another thrust up, then come in and test it. But ultimately, I think we work our way up here at about 160.20 on QQQ, at least before we really start to run into some resistance where we may either consolidate for a while or even have a decent pullback. But I think it's probably more likely to just get up here and consolidate for a bit, and then we'll have to take it from there and see where we. Okay, and here's the SPY 60-minute chart. Same story. There's the downtrend line. Was mentioned last week, so we popped it today, pulled back a little. We've been back testing. We have uptrend line support not too far away, and I think we work our way up to at least 250, 350, that area, sometime soon. You can see the PPO is getting pretty stretched. High levels starting to turn down. Maybe we get a bearish cross. Maybe we come back in. If we take out the uptrend line, maybe we continue to back test the downtrend line at lower levels. If you're long, remember this. I'm doing this video on the final trading day of the year where you're likely to see volatility. I mentioned that in the trading room today. You have tax loss selling, you have window dressing, just a lot of shuffling. So try not to read too much into what happens today. But again, near term, I think we'll see some money come back into the market in January because, my whole I factor, although technical analysis drives my entries and exits and in a large part formulates where I see the market going. My background originally is in fundamental analysis. Business major, stockbroker, financial advisor. And with a background in fundamental analysis. So I look at that and I do see a lot of differences. I don't want to go off topic too much now, but there's a lot of differences that I think between now and the top back in 2007. We have, first of all, what happened in 2007, especially when we started melting down in '08, that was a collapse of the financial system. So banks would have all gone bust if the government hadn't stepped in and bailed them out. Very few saw it, and it was a swift and powerful bear market. I don't think this one will be that same. I feel highly confident it won't. Everything I'm seeing out there on the horizon right now is stuff that's we've seen coming for many, many years. The huge federal deficit in the U.S. as well as other, sovereign countries, major developed countries, quantitative tightening, the trade wars, and all this. There's really no surprises. What happened here, and even before it happened, what I talked about, this was just an overcrowded trade. The big FANG stocks, it was technically driven when we finally had a breakdown of those long-term trend lines and technology broke down. As I mentioned, once tech breaks, the market would break. That started it. And then it cascaded from technology into other sectors, including banks and everything else. And again, I guess what I'm trying to get at here, without going on too long, that's not what I wanted to show you here. It's what I wanted to show you. Things are different today than back at the top in 2007. Number one, and this is just one of many, this is the US industrial production. And I went back to 2000, beginning of '05. You can see that industrial production was already falling leading up to the 2007 top, which came in October, right about here. And there's the recession or the drop off in industrial production. But that's when the market peaked. Now, and I did say this, that the economic indicators would roll over. I remember doing a video a couple months back saying that everything, and I mean everything, I read tons of articles, things I've watched in the videos on TV, talked about where will the next recession, where will the next bear market come from. Nobody, at least nobody that I can recall, had it coming anytime soon. They were saying, okay, maybe at the end of 2019, but probably beyond 2019 for the next recession or bear market. And they listed all the things that might, kill the bull market. And I said, I took a different view. I said, what would kill the bull market would be the bull market itself, that the technicals would drive everything else, that we'd get the breakdown, that the tech bubble was ready to burst based on the technicals. Once that popped, it would cascade and then trigger forced selling, liquidations from the overcrowded FANG stocks, indexing. It would cause pension plans and hedge funds to rebalance and reallocate their portfolios. A lot of forced selling, and all that's happened now. So where I'm going with that is, I do expect, over time, these economic indicators to tick down. But I just want to say that the economy is in better shape now, and we know that the banking system is, whether you trust the government or not, and the stress tests and all that. I don't think we're going to see a repeat of 2008. I just wanted to say that, and but I do think there'll be, we're most likely started a bear market, whether we have or haven't. I don't think it makes sense to tuck all your money away and put everything 100% long, 100% short. I've talked quite a bit about asset allocation, moving money into cash, things like that. But this is not a chart of the market, but you'll see this ebb and flow. Again, this is industrial production, one of many economic indicators, but just showing you that other than the correction that we had, I think is for the near term a little bit overdone, based on really fundamentals, where the strength of the economy right now. Again, it was more of a not the market repricing a recession, as is what I mostly heard from the mainstream media. But I think it was, again, just a popping of an overcrowded trade, a lot of forced selling, and I think for the foreseeable future, there's the key word. I'm looking out as a swing trader. I'm looking out right now. My blinders or my tunnel vision's looking out through, really, let's say, through the end of January. I'll take it from there as time goes on. I'll be looking out a little further. But right now, I don't care where the stock market is a year, 2 years from now. I care where it is in January, because if you are short, you're going to try to ride out a bear market rally, if that is what this is. Let's go back to the charts. So far, again, you've given up, just in the S&P 500, not even the more volatile tech stocks. You've given back 7.5% or so. Let's just say you nailed the top. And if we come back up here, by the time this thing runs its course, and who knows how far it can go. We'll try to identify it, and try to gauge how far it may go based on how the charts develop going forward. But I can't rule out, by no means. Well, I can't rule out anything. Can't even rule out a move to new highs. But let's just say in the cone of probabilities, or the cone of, not call it certainties, let's just say cone of probabilities. Let's say a move all the way back up here to test those triple highs. Remember, we had the triple top around 280 or so, 281. And if we got there, and it wouldn't be a straight line, I'll tell you that right now, but if we got up there, you're talking another 12%. And is it possible? Yeah, it's possible. And I'd say there's a decent chance. At the very least, I think we'll come up here and test these, come back test the lows. Everybody was clamoring for a retest of these lows back from earlier in the year, early in 2018. You have the reaction lows a little below that, but that's where trading normalized. So I just wanted to share my thoughts, and now let's dive into the near-term charts and give you my thoughts on where we might be headed. So again, this is what I posted on Friday, the 60-minute charts of SPY, QQQ. We'll get to the futures here in a second. So here are the levels that I'm watching. Remember, again, it is the last trading day of the year. Things may be a little choppy. Support levels may be sliced through, even if they end up holding. So you have to expect maybe some whipsaw signals. But I think we're going to see a pretty strong rally coming up here soon. We've already seen a pretty strong move off the lows, but I just see a lot of charts that look to me that the selling was overdone. So where are we at? We have popped above the downtrend line today on the 60-minute chart. We've been back testing it. We have uptrend line support not far below. I favor a move to at least 253.51 on SPY. And quite likely, this is where the resistance really starts to come in here around 262. So let me just say it this way. I'm not interested in shorting the broad markets other than for very quick. I'm an active trader. I mean, you might be confused in the trading room if I say I just shorted a NQ or ES or something, or SPY for a pullback. Maybe a quick trade, day trades, because volatility is at least for the time being here to stay. But I think we'll work our way up here, and this is an area where we start to come into some pretty significant resistance, because that was key support before. So we'll call it, give or take, about 262 on SPY. And to try to quantify it for you from where we're at right now, that would be another 5 or so percent. Let's look at QQQ. same story. There's your downtrend line. We took it out today, back tested it on the pullback. I made mention the trading room that back test was also a backfill of the gap in the futures. So I'm referring to futures rarely have gaps, but remember the index futures shut down on Friday and they reopen on Sunday night. So that's usually when you get your largest gaps on the futures contracts. So and I mentioned that as an objective level to add some long exposure today on that pullback. And so far we haven't really exploded or moved much higher off that level, but it has held. So you can see this trend line is acting as support. It was a breakout back test so far, and we have this uptrend line as additional support below it. So, how we get there exactly hard to say, but let's look for something like this. A move up to that 160.20 level on QQQ. That's a little closer than that level on SPY. We have a similar type near triple bottom there, and there's some. Once we broke below it, we back tested it. So that's a pretty important level. But I do think we'll work our way up there. These indicators are getting a little stretched. The PPO is starting to turn down here. But sometimes you have that. Sometimes it'll start to turn down and may even get a bearish crossover. I just for swing positions and all the longs I've scaled into over the last week or so on my IRAs, long-term accounts, I'm not at this point in time concerned about taking profits or trying to game a pullback. If anything, I'll buy a dip on pullbacks to support. So that's that. Let's look at futures real quick. I don't think I did it. I haven't done an update on those in a little while here. NQ. There's that uptrend line, perfect tag of that today. There's your objective buying up on the pullback to the trend line. Now it's a little scary. We're still in the primary trend right now, or at least the intermediate trend especially, is still bearish. And we're looking at a clean bearish rising wedge pattern. If this bearish rising wedge pattern came here or here or here, or even here, you go ahead and short it. But right now, with as oversold as we were on the daily time frames and everything else that's happened, I'm favoring that we can work our way higher. And so these divergences might remain intact, but we may, drawing 1,000 lines here, probably driving you crazy. I'm thinking we may continue to work our way up here. And that would be about that 64.70 level would be comparable to what I just showed you on QQQ, maybe 65.53 right here. So let's just say this is my target zone near term on NQ. And at that point, I'd expect either a decent pullback, probably a break of this trend line, but more so I'm leaning towards some consolidation for a while. And we're probably, of course, we're talking going into next week. This isn't anything that's going to happen today. Oh, I'm sorry. We have confused here. New Year's Day is tomorrow. Markets are closed, of course, and then we open up again on Wednesday, Thursday, Friday. So this is kind of my near-term outlook. A little more upside I'm leaning towards. You should respect a break of this trend line because there's traders are honing in on technicals right now. So if you break that trend line, you'll probably get a quick move down. My guess, if it breaks soon before we hit that target, that breakdown will prove to be a false breakdown. And it might be, if you're somewhat aggressive, buy the breakdown. You'll probably get a reversal back above. You'll have a ton of shorts short that breakdown, and I think we'll get a reversal, and then you have a beautiful little short covering rally, a little short squeeze if we reverse back up above the trend line, and then that could propel us up to that final target. So let's just say, that's a pretty detailed near-term scenario, but it's one I'd be watching for, and it might play out that way. So let me look at ES. ES, same story. It's almost identical chart here. This is, again, a 60-minute chart of the S&P 500 E-mini futures. There's your bearish rising wedge. It's pretty textbook. Your negative divergence, everything you like to see. Normally, I'd be ready to fire away a short on a breakdown of this. But again, favoring, even if we get a little false breakdown first, move up here to the, to this resistance zone, either of these levels there, somewhere in there. So a little more upside. As I said, I think I said it was about 5% or so on SPY. It should be about the same here. Okay, and I'm going to keep this video for members. I'll do an update later for public content. I want to get this out to you guys, the members of the site, so I'll give you some more trade ideas. Remember, the stock market isn't everything. If you don't want to chase after such a strong advance, or you're looking to short but you want to wait, or you're just looking for other trade ideas. And remember, there is a benefit. I'm a big fan of diversifying in that whether you're an investor and you're diversifying among an investment portfolio or you're an active trader, the more things that you can trade with that are not highly correlated. It's like I use the analogy of a car, especially for gearheads, the older, not the things that run out of the something goes wrong, the computer stops, the whole car stops running. But the old 8-cylinder V8, you lose one cylinder, the car is going to keep running. It might misfire. You can even drive an 8-cylinder, 2 cylinders out. It'll keep going. Engine will run rough, but that's the point of trading and investing. If you have 8 stocks or 8 different sectors and areas in your portfolio and one or two are going down, hopefully the other 6 are coming up or holding up in value. And so here's another trade idea: is crude. Crude's been beat down, had the snot knocked out of it. From a purely technical perspective, I shared some charts in the trading room today. You have a downtrend line right here that was recently taken out. There's a breakout back test, and you also have a minor uptrend line here, so you have intersecting support. And I think we can move on up here to 50.32. That would be a nice advance on CL. I'll get to USO in just a second. We had positive divergence here on the PPO. You can see at the lows recently. So this is, again, a 60-minute chart of CL, crude futures. Now let's take a look at USO for you traders that prefer the ETFs and don't trade futures. What we have is USO. Let's start with a long-term chart. We're at multi-year lows in crude. This was a big basing pattern back from 2015, mid-2015 through 2018. We broke out. We fell back into there. There's some support there around the lower end of the zone. I can add a line right here that captures these reactions back here, 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 and that's where we fell to, and it's right around that's where I put the line at 950. Very oversold, et cetera, et cetera, et cetera. Now coming back to the daily chart, what we can see is we have bullish divergence for the first time in quite a while. Nice positive divergence forming on USO as it falls down to that support level, and that could set the stage for a pretty decent rally. Probably come up here and test this recent consolidation area. You can see right around here we had a nice consolidation area. So let's just say the bottom of that being around 1060 or so, that would be an ideal swing target, and that could take us up on crude about 10% or so. It's certainly a falling knife trade, but we had that big green candle on the 26 right there, big bullish candle. So far, we haven't taken out the top of that candle. Look for that. If you don't want to jump the gun on crude, I think a move above the top of that green candle would likely bring in the buyers. But then at that point, if you wait, and you're targeting the bottom of that zone, now you're only looking at about 7.5%. But that's still, I shouldn't say only, that's a nice move in crude. But again, the divergence tells me we could actually, even do more than that. But I just wanted to share that trade idea. In the others, as you know, I've added some official trade ideas recently. KRE, we were stopped out, no big deal. That sometimes happens. And again, we had the big green candle, the reversal on the 26th with everything else, and we've moved above that candle. And again, I think if I'm not mistaken, I did a video on this sector as well, highlighting. If I didn't do that, I just want to say I've looked at a lot of the top components, and I think the selling was overdone in the regional banks. Even, another trade, XLF, I think the XLF was overdone as well. There's another one. I just think you'll get a little more meat on the bone, or bang for your buck, I should say, with KRE. What else? Let's see. Well, I mentioned today I did a video on cut and wood. I'll probably add cut as an official trade idea soon. That's a timber and lumber ETF. There's wood, home builders, ITA, is it? No, that's here it is, ITB, also a trade idea. I like this one. I went through a lot of the individual components, and I'll probably do a video as well showing you some of those. And keep in mind, ITB, it has not just home builders, it has companies like Lowe's and Home Depot. It has some of the lumber stocks that I covered in the timber and forestry as well. So you'll have a little overlap there. And of course, XHB is another alternative. Very similar, almost identical. It's a lot of overlap between the two. And then finally, there's a lot of things out there, a lot of sectors that are looking interesting. And again, we may get another jog down. This chart sort of looks like we might. This is TLT. Remember, this was recently a long trade idea that was long back there, but we had it long here. It was um, TLT, as I mentioned, is coming up to the what was the former final target, or actually effectively hit. I think it did hit it last week, but point being, it's coming up on pretty significant resistance. And if we do get the rally, I'm expecting more upside in the coming weeks here in the stock market. I think we'll see money come out of this. I'm not going to add it on as an official trade idea now as a short. TBT is the inverse. It's probably better off if you don't need to short. You can just buy TBT. It's two-time leverage, but then again, these are treasury bonds. They're not going to move too fast. So this is one potential trade idea. Pull back there. Although I'd rather just wait and re-enter treasuries at the right time. Gold getting pretty stretched. Another trade idea recently hit the final target. No, I left. This is still on as an active trade for a long-term trade. That's a trend trade. So I think we're probably going to get a pullback soon in gold, especially if the market does rally. If I'm correct on that, because you'll see the flight to safety assets, i.e. gold and treasury bonds, you'll see money come out of those. So we're starting to diverge here. This is a 60-minute chart of gold. I'm kind of all over the place with this one, but either way, I think gold is stretched for the near term. I don't really care. I'm not going to add it as a short trade. I mean, it's an active long right now. So I just want to kind of share those thoughts. And again, if that's confusing you, swing trading, where when I'm a swing trader or looking at a swing trade, a position as a swing trade, I'm looking out anywhere, ideally or typically several weeks to several months. Could be a little longer, could be a little less. Some swing trades close out in the same day. If you have a breakout of a strong chart pattern, and you can hit the same. I've had many trades, dozens, if not 100 or more, hit the initial or final price target in just one day, because a lot of the trade ideas on the site are explosive patterns like bullish falling wedge patterns. They break out and the stock explodes. Now, it wasn't meant to be a day trade, but sometimes you get those double-digit gains in a day. You take profits. Other times, a trade can take. You might expect it to play out in 2 or 3 weeks, and it could take 3, 4, 5, 6 months. But as long as the charts are constructive, I'll leave it on. Now, so as far as swing trading goes, yes, I closed the swing trade on gold, GLD, but I left on the long-term trade because I do believe, at least at this point in time, for those willing to ride out any pullbacks, and I could easily see a pullback back to this level right here, about 117 quarter or so. I doubt we'll go down here. That's the next decent support. I think something along these lines. Maybe the pullback won't go down that far. Maybe it goes back more. It's up to you. If you're still in this trade as a long-term trader, well, you should at least raise stops to entry at this point to protect profits. But that's somewhere along the lines of what we might see. But I don't want to give you a high degree of confidence on that scenario. I haven't really studied the intraday charts I haven't looked at the charts of the futures or anything else. But that's GLD. I'm going to wrap this video up here. We just hit the 28-minute mark. So those are some of the things, kind of painting not a full picture, but a partial picture of what I'm looking at heading into the new year. Like I said, just say near-term bullish on equities, near-term bearish on TLT, gold, near-term bullish on oil, and I'll have to do commodities are a whole other thing. There's so much variance within different agricultural commodities, industrial commodities, things like that. I'll cover those in a separate video, other than oil and of course in gold, which I covered here today. All right, this has been Randy Finney with the Right Side of the Chart. And again, have a happy new year, and I'll continue to follow up with any sectors or individual trade ideas that stand out. I'll try to get those out in the next week or so. I expect we'll have quite a bit, new trade ideas on the site.